An entire generation of people is about to experience higher interest rates for the first time in their adult lives. Interest rates have been at historic lows since the global financial crisis, but they're beginning to creep up.
If you look at what's happening around us today, we seem to have a situation that I think matches more what we saw 50 years ago.
Most people borrow money at some point in their lives, whether it's to buy a house, a car, for education, or to start a business. But with interest rates on the rise, that's about to become a lot more expensive. Here's why. Let's say you want to buy a car, but you're short $20,000. An option a lot of people take is getting a loan from a lender like a bank or credit union. In this example, a bank has agreed to loan you the $20,000 for your car, but the bank isn't going to give you that money for free. After all, there is a chance you could not pay them back, or that the $20,000 will be worth less in the future because of inflation. So you compensate the bank for the money. Interest is what you're charged for the loan, usually represented by a percentage of the total amount borrowed. The higher the interest rate, the more you owe the bank. This is one of the main ways lenders make money. So who decides whether interest rates are up or down? The answer is your local central bank. At a very basic level, the interest you pay the bank usually depends on a few things: how likely it is that you will pay the debt, how long it takes for you to repay the money, and your central bank's interest rates, and where they may head in the future. You see, a central bank is a bank for banks. If it raises interest rates, it makes it more expensive for your bank to borrow money. If the central bank lowers rates, it's the opposite, and that works its way out to the economy, and to you and your car loan. Central banks such as the U.S. Federal Reserve and the Bank of England use interest rates to try to manage the economy. And for the first time in more than 3 years, both central banks raised their interest rates. A number of countries have also raised their interest rates in the last 6 months, including South Korea, India, New Zealand, and Brazil. But why? As the pandemic devastated markets and slowed economic growth, many central banks made aggressive interest rate cuts. This lowered the cost of taking loans, which in turn spurred consumer spending and encouraged big credit purchases. Now, with demand recovering and supply chains affected by the pandemic and the Ukraine war, inflation has gone up.
This time round, we got this perfect storm, of both supply disruption and rising wealth that is creating, this very bad inflationary situation.
Lee Boon-Keng worked in the finance industry for 15 years and is now a banking and finance professor in Singapore.
Inflation is caused by what we call excess demand. Whether your excess demand is caused by falling supply or rising demand, it's still excess demand. A lot of people were thinking the pandemic will be more damaging economically. The fact that, there were a lot of government injections into the economy has somewhat lifted everyone. And that creates what I call wealth effect. We got geopolitical crisis. We got China, which is literally the manufacturers of the world, deciding that they need to have zero COVID and therefore is shutting down. So this is a very bad concoction. Rightfully, policymakers should be acting in a way to tame inflation.
And the main tool central banks have is interest rates. Raising interest rates has historically slowed economic growth and reduced inflation.
High interest rate was somewhat transitory. In the past, they somehow managed to tame it quite easily. And that is a phenomenon that we've seen easily for the last 35 years. Unfortunately, this time, what we're seeing is a period where inflation seems to be a little bit more structural. We have gone into a time where we sit back, look back in history, and couldn't find a time that is familiar to us that we can relate to. And I think that's the fundamental problem. And that, what I call policy hesitancy, has kind of caught the entire system by surprise. A lot of policymakers have been hesitant to react more structurally more aggressively to the current situation.
What would be the adverse impact on the average consumer who is experiencing high interest rates right now?
You want to buy your big ticket items, those are going to be more expensive. If you were borrowing money to run your business, right, borrowing costs is also going to be on the rise. It's not a situation for you to really go all out in terms of ramping up your loans and all these things so that you can take advantage of rising real estate prices and all these things. It's really about investing within what you're comfortable at.
But it's not all bad news. Higher interest rates can be good for your savings. Banks incentivize customers to save their money with them by offering to pay you interest. It seems like a good deal. You make money for parking your cash in a savings account. But generally, the earnings from these accounts for the last decade and a half have been minimal. And many people are choosing to put their extra money in riskier places, like investing in stocks or crypto instead. This shift in policy could change that.
We are in the repeat of the 70s, where inflation is going to be persistently high, at least for the next 2 years. We have to brace ourselves for a recession. Diversify, look at your finances, make sure that you're not overextended. My recommendation to a lot of people right now, make sure you hold your job. Your job is very important to combat inflation. There is this thing called great resignation that's going on. A lot of people think that, look, I go out there, if I quit my job today, I find another job with X percentage increase in pay. But once a certain tipping point happens, you will be what we call last in, first out.
Inflation is just a good excuse / chance to relook the non-discretionary basket that we think we're spending on.
There is no other way to end this inflation, given that supply chain disruption in the background, besides demand destruction. And demand destruction can only be achieved by very, very tight monetary policy.